GM, good morning. Welcome to the Milk Road Show, the daily crypto show that hits you faster than you can say, wait, how is he already on his second marriage? I'm your host, Jay Hamilton. It's Wednesday, April the 16th. Markets are uncertain. Yields are volatile. Inflation is sticky and CPI came in low, but inflation is still here in many ways. What do you do? What do you actually do right now? How do you make sense of all of this? Well, we've got former hedge fund manager and Bitcoin Opportunity Fund co-founder James Lavish joining us today to break it all down. We're going to talk about James's macro framework, what he's watching most closely right now. Bond yields, obviously, going to be one of the core conversations right there. The divergence between Bitcoin and risk on assets. Are we seeing something happening there? And of course, how do you position yourself in your portfolio during these times of uncertainty? We're also going to dive into James's probabilities for the short term, the rest of this quarter, and talk about James's Bitcoin prediction of 180K, which he made earlier this year. Is that still on? Is that still possible? And what do we need in order to get there? At what point are we going to reach a point of no return as a result of all this gamesmanship and all this trade war talk? Before we jump in, if you guys are going to be traveling to any conference this year, Milk Road is going to be at Consensus Toronto and Permissionless New York. We're going to have events there, free beer. Come on out, meet myself, meet the team. Check the link in the show notes if you want to sign up for those events. Today's episode is brought to you by MoonPay. Trade crypto fee-free, fast, and on your terms. It's also brought to you by Coinshift, powering top crypto treasuries with their yield-bearing stablecoin, CSUSDL. Without further ado, James, welcome to the Milk Road Show.
Thank you for having me, Jay. Good to be here. Always good to talk macro.
I love it. Always a pleasure. Okay. I'm going to start with a rather broad question, which is just like, how are you making sense of all of this macro noise that's going on right now? We've got, a debt crisis. We've got debt to GDP that's totally out of whack. We've got Trump trying to create this entire new monetary and fiscal regime, which feels maybe possible, but also could take too long, and we might go into too much pain. We've got China, which, who knows what's happened there. All these other countries seem to be coming to the table. I don't know. There's just so much noise out there. James, what are you paying attention to most right now? How are you trying to frame it in your own mind?
Yeah, it's a good question. And really the word of the day is uncertainty. And markets hate uncertainty. And you can see that the market's being, quite volatile lately. You've had large drawdowns in all of the major assets, including bonds, which is a little bit crazy. And we'll talk about that in a second. But, the NASDAQ has drawn down 25%. The S&P has drawn down 20%. Bitcoin's had a drawdown of 30%. And even bonds, you look at the 10-year, that has been extremely volatile. Why? Because of the uncertainty that's on the table right now. We have a little bit of a tariff tantrum going on, and you've got the markets are not receiving headlines very well. And any headline really moves the markets quickly. So whether it's Trump threatening or levying an additional tariff on China, whether it's the pause of the tariffs to allow for negotiation, the markets are reacting almost instantly. And this is a new thing, Jay. And this is not something that is typical when you get into periods like this. This is kind of new for Wall Street in that now you've got these headlines that are hitting instantly across the world. And it's like, it's not just the Wall Street professionals that see it on their ticker tape. It used to be, we had Reuters, and Bloomberg News scroll, and you could see the headlines come across, and then you'd react as a trader or as an investor, especially in hedge funds, or when we were on the institutional desk back in the 90s and early 2000s. That's where you got your news. It wasn't, you got some stuff. It was kind of delayed on CNBC. They had to do the back check. They had to make sure there was, and then how they want to deliver it, who they wanted to have on to talk about it. So that was all delayed, and it kind of delayed that reaction. But now it's like you see a headline, boom, you've got a reaction before you even know it's real. Like I'll give you an example about, I want to say it's almost 2 weeks ago now that, the Trump tariffs were were put in place. They were going to go into an effect within 10 days. And so about 2 or 3 days later, you saw a headline that said, oh, they're going to be paused for 90 days, source from the White House said. And then the market reacted violently and short covered and started buying all these risk assets off that headline. Turns out that the White House turns around and says, no, we didn't say anything like that. These tariffs are still going in effect in a few days. So just, that's not true. And then the market reacted the other way. So that's new. And it's also new for the market to react real time to Fed quotes. You've got Kashkaran coming in and saying that we've got Fed tools that we can use. You've got anything that Powell says, the whole street is like, well, what is he being dovish? Is he being hawkish? Is it going to be QT, QE? Like, where are we? Where are we going? And wait, did he say inflate? Did he say transitory? Like, what did he say? And the market reacts to whatever he says. This is just, it's almost mental. And so it's not an easy time to be an investor in this market. And it's funny because one of my investors, I was with one of my investors this last weekend, and she and her husband were talking to me over lunch, and they were like, how are you handling this right now? It just seems like it's neurotic or almost psychotic. And I said, well, we manage our positions and our sizing, and we manage our risks, and that's the best we can do. I'm not perfect, but we try to do our best to manage the exposures. And really, that's what it comes down to. So when you're in a period like this and you're trying to figure out what is going on, the most important thing is to be a strong portfolio manager, a strong risk manager in order to manage your exposures. And that's truly what it comes down to as a fund manager. But again, if you're an investor, what's your timeline? Are you 20 or 30 something? You've got decades and decades until you have to worry about having enough money where you're not working every single day? Or are you, in your sixes and you're thinking, I got to retire in the next 5 or 10 years and I don't want to be working until I'm 80. Like, where is your timeline? And so those things are important too. But so that's kind of how we see the world and how I'm seeing it right now, how I'm looking at it. But you asked in the beginning, at the end of your question there, what am I looking at? And the thing I'm looking at mostly too, I'm really keyed in on, is not Bitcoin. It's the bond market. I'm really keyed in on the bond market to figure out what's going on there, because that is the most important aspect of all of this. And that's the one that's going to tell you, what kind of reaction we're going to get from the Fed and the Treasury. That right there, that volatility is not normal. This is extremely abnormal. Because why? Well, this is the 10-year U.S. Treasury. This is literally the benchmark bond, not just Treasury, the benchmark bond of the entire world. And this is trading like this, a volatility in it. That's nuts. If you can bring up do you have the MOVE index as well? The MOVE. The MOVE is it kind of measures the volatility of bonds, and it's known as, that's it right there. It's known as the, and if you go out a little bit, like maybe go out 5 years or something, even more, it measures the volatility of the bond market. And this is kind of like the VIX of the bonds. And, you could see how it's been spiking recently. If you get up over 140, 150, like that is a massive volatile move. And you could see back in 2023, we had that happen. If you even go out further, you can, on like a weekly, maybe you can see that this thing really, this is where you want to pay attention, because when this thing gets out to, like, you're seeing like 160, like that is you can see where it went in 2020, right? You can see where it went in the great financial crisis. Like it is starting to tell you there are problems where we have issues. And so that's another thing I'm keyed in on. All right, that was a long answer, but that's kind of what I'm thinking.
So when you look at this right now, what are you thinking about where we could go from here? I mean, with the bond yields, we saw bond yields lowering, which obviously Besant and Trump, and they need to lower the bond yields in order to refinance the debt this year. It's a big problem, and we can talk about the debt problem in a second as well, because that's just such a massive problem that I'm not really sure what the answer is. And maybe Trump's plan is the answer, but maybe it's not. I don't know if we have the patience to go with the way he's approaching it right now. But when you look at it, we had bond yields coming down and then they spiked back up, seemingly as a result of China selling a bunch of their bonds, which sort of says who's buying these bonds in the long term. I'm trying to wrap my head around where does this go from here? What are the scenarios that, how do we get this bond yield to come down, and is it possible?
Well, let's start with, why do they want the bond yields to come down? They want the bond yields to come down because we have a problem with the amount of maturities that we have that are occurring this year. You know, if you look at the U.S. Treasury maturity schedule, and I'm going to try to see if I can bring it up here on Bloomberg as I'm talking through it, though. You've got somewhere around $9 trillion of debt that is going to mature this year, and that's a big problem. Why is it a big problem? Because we've got to refinance that debt at the same time that we're still running massive deficits of near $2 trillion. I know that the Doge Commission is doing their job. They have been doing their job, and they're doing it well. But the reality is they're not going to be able to get us into a surplus here. That's not realistic. And so if you bring this, so I'll bring this up. I'll try to share this with you. Okay. And so what is important here is that you've got this amount of treasuries that are now coming, they're maturing. Okay. Can you see this window? Is it showing this? Is it sharing this one? You see it? Yeah, there you go. So you can see right here, this is the number of treasuries that are maturing now in 2025. Okay. And they've got to refinance all of this. That's the problem. And then you've got another $3.7 trillion of treasuries that are maturing in 2026. Why is that the case? Like, what's happening here? Well, what's happening is that the back in the pandemic, when we printed all that money, Yellen was kind of put in a corner, and she had to refinance all this debt, and she had these massive deficits that were running. And so what did she do? She was like, well, I don't want to refinance this at 4.5% or plus on a, or even if it's 3.5%, 4% on the 10-year or 20-year or 30-year. I need to pull that in and kind of keep it short term, with the hope that they'll be able to refinance it at lower rates when the Fed lower rates later. Well, the Fed hasn't lowered rates enough yet. They lowered it at 1% last fall, but it's still pretty high. Okay, so now you've got Bessent, who came in, who was extremely critical of Yellen for a good reason. Why? Well, some people say, well, Yellen didn't know, that the rates are going to be high, so she was doing the best she could. Well, Yellen was the chairman of the Fed before she was the Treasury Secretary. She knew damn well that when we print $5 trillion and dump it into the market with an absolute money bazooka, that's going to cause inflation. And that's going to cause the Fed to have to turn around and raise rates to battle that inflation. So she must have known that this was coming. Why didn't she react earlier and refinance that debt further out on the yield curve earlier, meaning issue debt that was longer term? So you lock in lower rates. Well, now we've been sitting on these 3 some odd percent average rates for years now. And now Bessent comes in, he's like, and he was very critical about it. Now he came in and he's like, yeah, he thought that these rates would be coming down too, but they're not. Okay. Now, why are they not coming down? We're seeing evidence that the economy is slowing down. We're seeing evidence that inflation is coming down. We're seeing evidence that unemployment is going up. But why is the Fed not lowering rates? Well, the Fed's not lowering rates because they're terrified that we have a resurgence of inflation. Now, this is where it gets a little bit sticky, and this is where it gets frustrating. It gets frustrating that the Fed knows all these things that I just said, and they have said for years and years and years. Powell says it over and over and over again. He said, we're data dependent. We would rather lag the market and lag the economy, but use the data that we see, even if it is lagging by 1, 2, or 3 months, because that is something we can really key in on, and we'll be able to defend position basically that we have lowered rates because look, unemployment is up, or look, inflation is down. But they're not being data dependent now, because the last two times that the Fed spoke or Powell spoke, he mentioned the Trump tariffs, and he mentioned the fact that, well, they're expecting inflation to go higher because of tariffs. Well, that's not data dependent. That's speculation. And will prices go up because of tariffs? Well, maybe. We don't know exactly what the tariffs are yet and where they're going to be levied and what exactly they're going to be levied on. We have an idea that it will be inflationary, but we don't know. And we don't know how bad the economy is going to downturn here at the same time. So this is where it gets a little bit dicey for traders and how they're trying to figure out where's all this stuff going, right? And that's why you've got massive uncertainty in the bond market. So now you have these tariffs that come on. Okay, so why are the bonds selling off? Why are rates going higher? Remember, when bonds sell off and they get lower in price, that means that the yield goes higher, because you're paying less for a bond that has the same coupon on it. And mathematically, that just means that the yield of the bond that you bought in the market is going to be higher than that coupon because you bought it under par. If you buy it under 100, that means that you're getting a better yield, because now you divide that yield by the amount that you paid for it. Okay, so why are they spiking higher? Is it because China's selling the treasuries? Well, we don't have evidence of that, but we do know that we've got a few things going on that could suggest that if China sells those treasuries, it could cause massive turmoil. And that's what people are worried about. So they want to get out of some of these issues before those bond yields go up in their face and they wind up losing money like they did back in 2021, 2022. Because remember, and I'll see if I can bring up another chart for you, because this is what people are a little bit scared of. People are scared, and investors are scared, that we have a huge spike in that in the treasury prices, and if that happens, that we would have a scenario where people lose a lot of money, or investors lose a lot of money because of it. And that's what people are worried about. That's what people are very worried about. So the question is, what will happen between now and then, and how bad is it going to get? Well, is China actually selling? I have not seen the evidence of that, like I said. However, you have a big problem in front of us that has to do with this thing called the basis trade. And I'm sure you've heard of that, but I'm going to pause there and we can go into the basis trade in a second, if that sounds good.
Yeah, let's keep rolling. Keep going, okay. James. You're on a great roll.
So here you go. So let me share this. Let me share this chart again. And I didn't tell you I was going to keep doing this. Sorry, but here we are.
So it's all good. Share away.
So you see this chart?
Yeah, give me one second.
This is what investors are worried about. Investors are worried about this drawdown that occurred, and they don't want to get caught out on this again. Who's really worried about this? Well, the ones that are really worried about this are these hedge funds who have this thing called the basis trade on. What's the basis trade? You've heard, maybe some of your some of the listeners have seen me.
Go ahead, explain it though.
Yeah, I wrote about this in my newsletter recently. Well, the basis trade is pretty simple. It's an arbitrage. An arbitrage is where you buy one security and you sell another one short against it, and you lock in that the differential between them, because one is essentially the same as the other, right? And so you've got this arbitrage between the two. And what you do is you buy one, you sell the other, and you trade around it. Sometimes you can collapse that trade. You can deliver the long to the short in order to close out the trade. And that would be, if you get to parity, then you've made all the money. But you can trade around these things. And so what happens is these hedge funds, they buy a treasury and then they short a treasury future against it And there's a little bit of arbitrage in the price between those treasuries and the yields between them, where you can kind of trade around and make a few basis points. Doesn't sound very interesting, does it? Well, here's where it gets interesting. It gets interesting when you take that treasury that you've bought and you loan it out, right? So you go and put it in a repo market. It's a private repo market to another hedge fund or a bank or whatever. You loan it out and you get cash for that. You get that cash and you turn around and you do that trade again and again and again and again. And you do this until you lever this thing up 20, 50, or 100 times. Oh, now that basis point is 20 basis points, 50 basis points, 100 basis points, or 2 or 3%, depending on how many basis points you grabbed, right? Mm-hmm. So now this gets interesting. Okay. But really gets interesting is the fact that these geniuses have put this trade on to the tune of about $1 trillion. This trade is so big now that they're a little bit scared. Oh my God, these tariffs. Oh my God, China. Oh my God, what if they start selling these treasuries? And that what happens? Well, the spread blows out. The spread between the futures and the real treasury, okay, blows out, and they get hurt. Not to the tune of 1 basis point, but to the tune of 1%, 2%, 3%. And so this is where it's not just 1 basis point. This could be like a 20, 30, 40% loss on one of these trades. And that's, when they've got it levered up so big. So they start getting nervous and they start unwinding this thing. Well, that's kind of the worry. And I think that we saw bits and pieces of that the last week and a half, 2 weeks. So why is that important? It's important because you've got something called the Brookings Institution. The Brookings Institution, for those of you who don't know it, it's a think tank. Okay. The think tank, which is really it's kind of a tacit research arm of the Fed. Why do I say that? I say that because there are a lot of former Fed officials that work at Brookings Institution. And the Brookings Institution has been well known to do research on like Fed tools and implementations they can use. And then suddenly those things go into effect. One of those things that some of you have heard me talk about is the SOM rule. Well, Claudia Somm worked over at the Brookings Institution and came up with this measure of unemployment that says when unemployment does this certain thing, which goes up more than 0.5% from its lows, that I'm simplifying it, but basically it goes up more than 0.5% from its lows of a cycle, then you're in a recession. And it's been 100% right for the last number of recessions since the rule came into effect, or since they started looking at the rule. Well, now you've got the Brookings Institution that's looking at the basis trade, and they just put out a white paper, and it said, we have a solution for the risk of this basis trade, because the basis trade could blow up Wall Street. For those of you who don't know what I mean by that, back in 1998, this is why they're so worried about this thing. Okay. Back in 1998, you had this firm called Long-Term Capital Management. Long-Term Capital Management is a firm that was run by a couple of geniuses themselves who won the Nobel Prize in math for coming up with the Black-Scholes option pricing model. Well, these guys started a hedge fund called Long-Term Capital Management, and that hedge fund was doing arbitrage. They were doing interest rate arbitrage. They were basically doing a very similar trade to the basis trade. And among other things, they were doing it with convertible bonds. They were doing it with merger arbitrage. And what they had done is they had gone out and used swap lines with the various investment banks, their prime brokers. And they went out and borrowed money and did these things over and over and over again, to the point where they were levered up what we believe to be over 100 to 1 on their trades. The street started. So what happened is 1998, these guys, they have $1 billion worth of, now remember, this is 1998. They have $1 billion worth of capital, and they have $100 billion worth of positions, 100 to 1. That's kind of similar to this $1 trillion now. Okay. It was so big back then. Well, the Russian ruble gets devalued. Suddenly the interest rates and treasuries, those trades blow out, and you have these guys starting to get hurt on this trade. The street gets word. And what happens when the street gets word? Well, the sharks start to circle. and they start to sell those same positions, and they start to short those positions, and they're forcing long-term capital management to capitulate, which they did. And they turned around and they were going to wipe out. They were basically going to take down Goldman Sachs with them, because Goldman had so much exposure with the derivatives, as we understand it back then. Well, that was a big problem. The Fed had to come in. The New York Fed had to come in and engineer a bailout with the other investment banks to help them, to make sure that they didn't go under. Okay, so this is why the Fed is so nervous. The Fed is nervous because, oh my God, what if we have another long-term capital management on our hands here? And the Brookings institution said, well, we have a solution. And here's the solution. Instead of just printing money and saving the bond market if this starts to go south, what we'll do is we'll just take the whole trade from the hedge funds. And what I'm talking about is taking the long side and the short side and putting the entire trade on their books. It's absolutely, utterly fucking mental that they're even considering this. Like, this is just insane. Like, now the Fed's going to be a hedge fund, right?
Oh my God.
So that's how big this is. That's how scary this is. It's mind-blowing. Okay, so why are these bonds trading down last week? Because people are worried that this basis trade is blowing up. And the Fed hasn't said anything yet. They haven't said, well, we're going to come in and save them. However, we did have Kashkari say this last week. He said, we have plenty of tools that we can use to help make sure that there's liquidity in the bond market. Well, maybe that's one of the tools. And then there are other ones that they've been talking about as well. But anyways, so that's kind of what's been going on in the bond market as people anticipate what could happen.
Okay, I wanted so much to digest here. I want to continue with a little bit more on the Fed and what they can do and what we think they might do and what the market is pricing in. Their meeting coming up in a few weeks, May 7th, I believe. I want to chat about that. And then I also, I want to come back to Trump, Bessent, and the administration. And you've done a great job of explaining what they are really trying to do and what their ultimate aim might be. Because I think if we understand that, then we can understand, is it achievable and in what time frame might it be achievable? And it helps us understand how likely are they to push all the way through on this. You know, onshoring all these jobs back in America is a great idea in many ways, and you can argue whether it's good or bad, but the time it takes to do it, and like, will the market allow that and last that long? Like, that's my big question. So but before we touch on that, let's talk about the Fed. So you mentioned this, and you put out a tweet the other day. Let me pull this up here, where you were talking exactly about this, which is Kashkari said that the Fed has the tools to provide more liquidity. And you said, choose your phrase of translation, all roads lead to inflation. Nothing stops this train. The Fed will print again. What do you think the Fed is setting up for right now? And what's the market pricing in? What are your predictions of what they're going to do next year?
Yeah, well, there's a couple of things. So they could provide more liquidity in lots of different ways that could come in lots of different acronyms, like the BTFP, the Bank Term Funding Program, what they came up with when Silicon Valley Bank was collapsing. They came up with this thing that said any of these other banks that have liquidity problems, well, they can borrow against their treasuries without having a penalty, and with it being basically interest free and all that. So that's QE, not QE. What I'm talking about here is QE, not QE, where they provide enough liquidity, they expand the money supply or something that it causes inflation. We know that inflation is caused by the expansion of the money supply. It's obvious. And so that's why anything they do will lead to inflation, in my opinion, even if it is something called there's something called the supplemental leverage ratio. And back last year, I think it was beginning of last year, ISDA, the International Swaps and Derivative Association, they're the ones who kind of advise the Fed on derivative exposure and that kind of stuff. So, but they also work very closely with banks, and banks work with them on their so they understand the bank reserves and the dangers of reserves getting low. Well, back then they started talking about maybe we should change the leverage rules where the banks don't have to list U.S. Treasuries as an asset that's a risk asset, because it hurts their leverage ratio and it prevents them from owning more bonds. Well, they're talking about possibly scrapping treasuries from being included in that ratio, which means that banks could basically own unlimited amounts of bonds, and they would be considered cash, like riskless securities. You saw the chart that I just put up there. They're not riskless. Like, that's just utterly absurd.
Yeah,
you know, I mean, I'm still sharing it. Like, you show me that, like, that's not riskless. I'm sorry, but that's not. Okay. So, I mean, it's just insane. Now, the reason they say it's riskless is because they say that, yeah, but if you hold them to maturity, that the U.S. has never defaulted on those.
Mm-hmm.
Okay, let's just talk through this for a second. That's true. That is absolutely true. That the U.S. has actually defaulted momentarily before. It's like 15 minutes or something, but they rectified it pretty quickly, and that was during one of those the debt ceiling problems that we've had over the course of the last 5 decades. But they do default on these. They default on them every day. It's called a soft default. And that soft default is inflation, expansion of the money supply, meaning that the dollar is being debased, meaning that when you pay back those bonds later, you're getting paid back with dollars that are worth less than when you lent them out. That's a default. And so it's true. They don't hard default. They never have hard defaulted. Who would hard default if you can print money and just pay that out instead, right? So no country would hard default. So with that, I agree. With the soft default, I disagree. With them being riskless, I hard disagree. Why do I hard disagree? Because there is no guarantee that these will not default in the future. Do I believe it's going to happen in the near term? No, I don't. You know, some people are further along the curve on that. One of my investment partners, Larry Lepard, just wrote a book called The Big Print. It's a great book. People, anybody who hasn't read it, I strongly suggest you go out and get a copy. And he believes that we're closer to the collapse of this whole debt system than I do. And so they aren't riskless. But let me get back to the point here. The point here is that there are ways that the Fed and the Treasury can create more liquidity, and that's one of the ways. And when you create a way to for the banks to hold treasuries on their balance sheet without any risk measure whatsoever, well, that just creates the ability for more debt. That creates the ability for more leverage, and more leverage equals more money in the system, equals further expansion of the money supply, equals further inflation, which means further debasing the currency, which means soft default every single day. So that in and of itself is the issue here. And that's why I say that all roads lead to inflation. Okay. Nothing stops this train. Why does nothing stop this train? Because we're at a point now. If you listen to Lynn Alden talk about this, very, very well read and well spoken on this point. I will try to not butcher her words, because it's really important for you to listen to what she has to say about this. But the bottom line is that we're in a system that is dependent on debt now. And because we are at 120% debt to GDP, it's virtually impossible to stop that. Is it impossible? No, nothing is impossible. Okay. There's a very narrow escape to this, and that has to do with Bitcoin, and that has to do with saving our treasuries with having enough Bitcoin on the balance sheet of the U.S. Treasury that the confidence in the U.S. Treasury remains, which means that the confidence in the U.S. dollar will remain. So the funny thing is that people talk about that Bitcoin ruining the dollar, it destroying the dollar and treasuries, when the fact is it could save it. Okay. But either way you look at it, nothing stops this train. There's going to be inflation. They are going to have to do something to help make sure that there's enough liquidity in the treasury market, because the whole world, not just the US, but the whole world depends on US treasuries being solvent and being liquid and tradable. And if they're not, well, then the carousel stops, you're caught without seats, and the whole thing collapses. So that's the big problem right there.
So the Fed's got the ability to do what they need to do in the short term to provide liquidity. They can lower rates. Inflation is low right now, according to CPI. It might not be low if you walk into the grocery store. It depends on who you ask. But the Fed has those abilities.
That's an important point, though. That is actually an important point. The point is that once you have inflation, it's embedded in the price. The price is not going down again unless you have a massive...
of like everyday products, right?
Correct.
Like, sure, commodities might come down, oil might come down, those types of things might come. But you're saying, which is true, right? Is all of a sudden the like the table that I brought from Home Depot or wherever going to come down in price? No, that's the new sticker price. They're not going back on that.
That's right.
Trump, is this going to be a moment that we look back on decades from now as a significant shift in the US economy? And if that is the case, is Trump have the patience required in order to see this type of a shift through? And is he willing to take on that much pain?
Good question. Trump understands that he needs Congress on his side, and we've got midterms coming up. We're going to be deep in the heat of battle for midterms in 1 year from now, right? And so the question is, does he have the stomach? Well, I think it's less stomach, and it's more, does he have is he able to navigate this within that time frame? That's really the question. Mm-hmm. So I think, honestly, that a lot of people are expecting the scenario where he pushes this to the absolute limit. The stock market breaks. It breaks down again. It breaks down to the point where the Fed cries uncle and has to lower rates. And then he wins. Because if the Fed lowers rates, they're not going to lower it by 25 basis points. They're going to take 50 basis points or a full percent out. Boom, boom, boom. Because they know that, oh my God, the economy is collapsing now. Why would the economy collapse? Because we are so financialized. We are so tied to this stock market. We are so tied to the prices of these stocks and our homes. And so if you have the stock market collapse, you've got the home market collapse, you've got everything correlates to one, which means that every single thing goes down in price. Well, that's drawing liquidity out of the market. Why? Okay, so when you have margin, when you have the entire stock market, a lot of it is based on margin, liquid, and leverage that we just talked about. Maybe it's not 100 to 1, but a lot of it is 2 to 1. Well, when you have leverage and you have margin, when the stocks go down, what has to happen? Well, you have to sell some of your stocks in order to put up more collateral, which means you take money out of the market. It removes liquidity out of the market. And it's not just stocks, it's also bonds. When you have volatility in bonds, that raises the amount of the collateral that you have to have on in order to borrow against it, which removes liquidity out of the system. It raises the amount that you have to have in that position in order to borrow against it. You can't borrow more. So that means that liquidity comes out of the system. That means that you've got liquidity, you've got money literally coming out of the system, and there's less money to go around, which means there's less money for goods and services, which means that the goods and services fall, the demand falls, and you get into this spiral where you're in a downward spiral in the economy, and you're going into or suddenly deep in a recession. Now, we saw an extreme version of this in 2020 when they decided to just shut down the whole economy of the entire world. Again, another genius move by our globalists. But we decided to just shut it all down and let's see what happens. Yeah, well, we saw what happened. We saw it happen, and it meant that every single central bank in the entire world had to print so much fucking money that we had to keep the entire thing going. That here we are still battling inflation from it 5 years later. And when you go to the stock, when you go to the market, you go to the grocery store, you go to buy a car, you go to pay the insurance on your car, you go to pay the insurance in your house. All this stuff is so much higher than it was before, and you're struggling because they printed so much money. And so what am I worried about? I'm worried about that they're going to do it again. That's what I'm worried about. And so my worry translates into positioning myself to not take advantage of that as much as protect myself from it. And that's why we love Bitcoin. Like, truly, that's why I love Bitcoin, because that, I think, is the pristine capital or the pristine asset to protect yourself from all this nonsense in the future. Is it volatile? Yes. Will it continue to be volatile? Yes. Do I expect to go up in price? Yes. You're going to ask me where I think it's going to go. I will tell you that I think it's going higher. I said a long time ago, I think it's going to go to $180,000 this year. I do still think that's in play, especially if what you just said, that Trump decides to push this to the hilt, right? To put it on tilt and, you know, and shake up the pinball machine where everything breaks and that's it. You've got to come in and reset. And that reset is not a $5 trillion print. It's a $10 or $20 trillion print. And oh my God, you better be in the position to save yourself from that, because it's going to be a V-shaped recovery. And so that's my concern.
Because if we have this pain continue and we go into this recession, we're going to have even more debt. The debt's going to increase because nominal GDP is going to decrease.
Right. Taxes go down.
Taxes go down.
The claims for unemployment, the claims for Social Security go up. Yeah,
go up. You know, and sure, okay, tariffs is a revenue source, but what are we talking here? Like a few $100 billion? Like it's not enough, right? Like when you look at, and sure, Doge could decrease by, I don't know, a few $100 billion as well. Maybe 500 billion would be like an incredible target for them in my mind. I don't see them cutting by more than that. I don't know about you.
Well, and the hope is, though, Jay, the hope is that you're bringing back manufacturing into the United States. You're creating more productivity here. That's going to take so long.
It's going to take so long. Yeah.
It's not going to happen overnight. You've got regulations. You've got to get approvals. You've got to get environmental approvals. You've got to get, and then you've got to source the site. You've got to buy the site or lease the site. And then you've got, it doesn't happen overnight. Like that's not something, you don't have Microsoft coming in and say, we're going to bring all these people back. We're going to go, that Coca-Cola. I mean, that's a lot. So. Yeah.
And I understand.
Or the chip. I mean, the big one is the chips, right?
I was going to say the big one is AI and tech and robotics, and having that supply chain being in America and not being so reliant on our partners who, hey, if AI continues at the rate that it's going, we need to be able to, I say we, I'm not even American, I'm Canadian, but America needs to be able to control, I mean, I'm basically an extension of the US at this point, needs to be able to control a lot of the supply chain because there's a lot of risk there. Okay. So one probability is Trump pushes this so far, and the Fed comes in and saves it. What are any other scenarios?
Is that my base case? Well,
is that your base case? What are the other scenarios right now?
It's not really my base case. It's more of my fear that that could happen, and we have another 2020 moment. No, my base case is that he's going to use this, and he's going to threaten other countries. He's going to use his big sword here, and he's going to find ways to win. He's going to win back a little bit of balance here for us, for the United States. And so that's what I think is going to happen. I do think that, he knows he's not a stupid man. People think he just acts off the cuff, but he doesn't. He really is thoughtful about this stuff. If you talk to the people behind the scenes, they'll tell you that he really does have a plan here. It seems diabolical, but he does have a plan. He's willing to do things that most other people are not willing to do. He's willing to be hated, but look, I don't agree with exactly everything he's doing, to put it there, but I do believe that the market is not looking great. It is overvalued, right? The stock market is overvalued by pretty much any measure you can use. You do have a ton of fear. You've got a lot of uncertainty, which means that people are bearish. It means that the confidence is very low, and people and investors are positioning themselves accordingly. That's kind of a contrary indicator. Remember, if people are bearish, that means they're already out of the market. Right? If they're too bullish, it means they're already fully in the market and there's nobody else to come in. So it is a counter, indicator. But I do believe that we're going to get into a period here where we have just choppy markets for a while. But once some of this stuff gets resolved, the interest rates come down. Interest rates on mortgages come down. Interest rates on cars and other things come down. That all helps to lower interest. It all helps to lower the cost of insurance, by the way, because insurance prices are also keyed off of interest rates in many ways. And so, that will help the economy. It'll help stabilize it. And then you'll kind of, see it hopefully recover. Now that I don't know how long that takes. I don't know if that's a 3-month, 6-month, 18-month period, because this could take a long time. This could take right through the midterms for that to kind of play out. But, you've seen, I've been watching the interest rate probability monitor of Bloomberg and trying to figure out exactly what traders are thinking. And one more thing, I'll share this one more image here, and to give people an idea of what I'm talking about.
Yeah,
this is the interest rate probability monitor for Bloomberg. And we've seen here, this is December, right? So this is Fed funds futures. Don't have to understand this math. Don't worry about it. All you have to do is look at this. This is what the probability say there's going to be 3.5 cuts between now and December, by December 10th, by that meeting. Here are the meetings. You got one in May, one in June, one in July, one in September, one in October, one in December. This is saying there's going to be 3.5 cuts. One cut is 25 basis points. Okay, so it's basically saying that, it's 89 basis points is the implied amount that's coming down. Okay, so that's what people. But this has been as high as 4.5 or 4.25, recently. So that's the crazy thing. It's moving around. That people are trying to figure out where is this interest rate going to be, and where is it going to bottom out. And you can see here that people are now figuring that it's going to bottom out here somewhere around 3.2. And that's kind of where we're going to base out. And that'll be the long-term neutral rate. That could be a lot lower. We don't know. And that's the big question is where does this go? How much does the Fed really move? And how effective is it? So that's what I'm watching the bond markets. Like I said, I'm really watching the bond markets to get some clues there on the health of the health of all the markets, because they're keyed off that bond market quite a bit. I'm watching gold and seeing what that's doing, because that gives you an idea of how much people are worried about, how much investors are worried about risk. Gold is a good indicator of that still. And another one I'm watching is Bitcoin. I'm watching it decouple from risk assets here, and that's very interesting to me. And so that's an important data point as well.
Yeah, I want to talk about Bitcoin before we wrap up here, James. So let's talk first about the decoupling. This is the decoupling of Bitcoin from the NASDAQ and risk assets is something that I feel like has been said many times over the years. Oh, it's finally happening now. And then you wait a few days. For some reason, Bitcoin always seems to follow the stock market when the drop happens by like 2 days to like 7 to 10 days. And I can't exactly explain why. Maybe it's because of weekends or something like that and 24/7 trading. Mm-hmm. But talk to us about the decoupling, and then let's lead into your thoughts on Bitcoin.
Yeah, I think part of it is what you just said. Part of it is that, look, you cannot deny that Bitcoin has been treated as a risk asset for years here. I mean, it's just what it is. It shouldn't be. I believe that it's not a risk asset. I believe it's a risk off asset, just like gold, except a better form of that. However, it has acted like that because people don't understand it very well, and they still consider it just this technology, this nascent technology that they're not sure if it's really has any value or if it's just speculative. And that's one of the big problems. But why is it trade so much on the weekends? Well, the reason is, especially over the last like 2 weekends ago, you saw Bitcoin plummet at the same time, like over Saturday, Sunday. And there was really no headlines. It was on very little volume. well, why did that happen? Well, it happened because it's what we call a buyer strike, number one, where there were no buyers of it, but there was this need for sellers. Sellers needed to get out of it. Why were they getting out of it? Because there was a huge fear. If you remember just a couple of weeks ago, there's this huge fear of there being a big Black Monday.
Black Monday.
Oh my God, it's gonna be Black Monday, 1987 all over again. Oh, let's get. So what happens? When a Black Monday happens, just what I talked about earlier today is you get margin calls. It means you got to put up more money for the positions you have. You have what's called a haircut on your positions. And for the very, very, these huge blue chip companies, the haircuts can be minuscule. They can be like, if you have certain portfolio margining agreements with your prime broker, you can be like just 5, 6, 7% of the whole position. That means you can borrow 93 to 95% of the position and only have to put up 5% as collateral. Well, when you have a haircut, when you have a margin call, or when you have volatility that enters the market, then that pushes that haircut up. That means that it might go to 10 or 20 or 30%. Well, that's a lot more margin that you have to put up, which means that you got to come up with a cash. You've got to sell something. If you don't have cash sitting in your bank account, you got to sell something, come up with that. Well, what trades on the weekends? What trades 24/7? What's very, very liquid? Bitcoin. You can turn around and sell Bitcoin and get ready for your margin call Monday morning and have the cash sitting in your account because you put yourself in a position where you're not going to have to sell other things that are down on Monday. You could sell Bitcoin, which is still up from the Friday. Maybe it's down a couple percent, 2, 3, 4, 5%, but it's not down 5, 10%, which is what you're scared about in a market crash scenario. And then it snowballs where you're selling something, it begets selling, it gets worse, you have to put up more margin for it, and these big hedge funds get concerned with that. So they sell Bitcoin because it's easy, it's liquid, it trades 24/7, it's right there. Mm-hmm. So that's one reason that it decouples on the weekends.
Yeah, I've always. When's the best time to buy Bitcoin? Sunday evenings is often one of the best times.
Or exactly. Or when Jane Street comes out and does their their daily algorithm. And then another thing is the it's the reversion to the mean on that exact opposite. So during the week when the market's doing something, Bitcoin may do something different because it's already had its move. Well, we saw Bitcoin draw down over 30% from its all-time high, or about 30% from its all-time high. I'm just using peak to trough. I'm not using closes, but somewhere around there. And the market had only been down 10%. So now Bitcoin's kind of, I believe, found a local bottom here. Is it going to be the bottom forever? I can't say that. I mean, I'm not going to predict that. Bitcoin is volatile, so are the markets, and who knows? The headline risk is massive right now. But it has found a local bottom, and so it continues to decouple here. How long that lasts, we don't know. I would like it to last for a long time because that would make me much more confident in the full decoupling, which I think is going to require a lot more understanding of exactly what Bitcoin is, and more companies and investors in these companies, the CIOs of these companies, the CFOs of these companies, willing to use Bitcoin on their balance sheet in order to fight exactly what I was talking about with the risk of the treasuries. And when they start adding it to their balance sheets in their treasury themselves, and they start removing allocation from the bonds, that's when it really fully decouples and it's game over and Bitcoin wins. Which
everybody on this show would assume is inevitable. And I think everybody listening would agree with that. So we don't need to get into that discussion. I want to just wrap with, okay, so if your prediction at the beginning of the year was 180K Bitcoin, and I know you, like me, hate making predictions, they're like buttholes. Everybody's got one, it's not helpful. So everybody listening, do not hold us accountable to our predictions. But there is this belief that Bitcoin is going to finish the year higher. You and I both agree on that. There's no doubt there. How high? Okay, we'll see. What needs to happen? Is this an inevitability where you think Bitcoin finishes higher no matter what, because both either the Fed or Trump is going to blink to the point that we're going to get either liquidity from the Fed, or we're going to get Trump backing off tariffs because he gets to the point where he's like, I actually don't want this much pain. It's gone too far. Or is, or is it, could we get to a point where this does spiral and Bitcoin doesn't finish the year higher?
That's a good question. Again, I lied. I'm going to share one more thing. For those of you who did not see my discussion with Michael Howell, I had discussion.
We got him coming on the show next week. So
great. Well, this is his newsletter. Michael, thank you for letting me, use this publicly. But Michael talks a lot about global liquidity, and he's got a great, proprietary model that he uses, and a lot of it, of what I just talked about with volatility, is embedded in his model, and it's really important. So if you look at global liquidity, and this is really important here, global liquidity is on the upswing. Risk assets follow that, and so what's really important about this is if you look at Bitcoin and global liquidity, there's a lag here. If you guys can see this, right? And maybe I can share it on this, so it's a bigger one. Sorry. No, I can't share it on there. But basically, you can see here that global liquidity and Bitcoin follow lockstep. However, there's a lag of about 3 months for Bitcoin, I believe, like 10 or 12 weeks. So this whole chart is staggered to show that. So look at what's happened with liquidity here. So we had Bitcoin kind of get ahead of itself. Liquidity had dropped. Bitcoin got ahead of itself, went over 100,000. Okay. And then it came back down as this liquidity is going up. So here's why I think that's important. This relationship is important. The relationship is important because of this global liquidity. Okay. Where if you look at here in October, I think of 2022 is when global liquidity kind of bottomed out, and it's been rising ever since. Well, Michael contends that there's a 5 to 6 year cycle of liquidity, and that we're going to hit the peak of that cycle at the end of this year in fourth quarter. Okay, so liquidity is going to rise into the fourth quarter. How much it rises depends on just everything we talked about. How much are they going to add liquidity to this system? Because it needs to be there. It must be there to continue this debt charade, right? So how much is added? How much pain, economic pain, do we suffer in between? And how quickly is added? I don't know. But all things being equal, liquidity continues to rise. Bitcoin continues to match that liquidity in a 10 to 12 week lag. And so we'll see Bitcoin kind of peak if liquidity does do what it's been doing over the last number of cycles, and this 5 to 6 year cycle plays out through the end of this year. Well, then that would tell you that Bitcoin's going to hit its all-time high somewhere between the fourth quarter and the first quarter next year. And so, it's a really good way to look at it, because all comes down to liquidity, in my opinion. And so we're going to have expansion of liquidity. It's just it's just a question of how much.
Yeah. It feels inevitable that we're going to have this expansion of liquidity, which will funnel down to Bitcoin, and Bitcoin rises along with other risk assets as well as liquidity flows through.
And that's why, when people ask me, like, how are you positioned in the hedge fund? Well, I'm positioned long and I'm exposed to Bitcoin and Bitcoin related companies. That's all we do is Bitcoin related companies, public and private. But I do have hedges on just in case we see a strong drawdown in the general market, in order to protect myself from that momentary drawdown and be able to have liquidity to go in and take advantage of it. That's where it's really important for people to understand, is that the volatility is a gift for Bitcoin. If you have access to liquidity, it allows you to continue to add to your position at better price points, even if you're just doing it on, a DCA. If you're dollar cost averaging into it, it helps. So,
yeah, I've been saying for a while now, anything below 78K, I'm a buyer right now. That feels like a great number. A few times we have hit that. James, before we let you go, I want to ask you quickly about Bitcoin Opportunity Fund. You guys have just launched your second fund. Tell us a little bit about that.
Yeah, so the fund one is closed. We closed it because it has public and private investments in it. We decided to open a second fund because we had a lot of people come in and ask if they could add to their first their
You're
first.
doing well, my man. That's great.
Yeah, the first fund it did very well. It was in about 5 quarters, it was up over 80% net to the investors, wow. About 85%. So so that was great. We had investors asking if they could add to their investment, and so we ended up, and some people who missed the first fund. So we ended up opening the second fund right as the market turned down, but we've done well. We've raised about 20% of the capital that we're hoping to raise already. So that's good. And so it basically, the Bitcoin Opportunity Fund invests in public and private investments in the Bitcoin ecosystem, anywhere in the ecosystem. And so we are a little bit different than VC. We'll do some early stage stuff. We don't do a ton of it, but we like to say that we're focused on real companies with real revenues and real profits, and that's really our core focus. And so that's what we do. And the second fund is open. So if you're an accredited investor, then just go to www.bitcoinopportunity.fund. Give us your information. We'll get in touch with you or send you some stuff about the fund and let you know what it looks like and whether we think it would be right for you. We're happy to jump on a call to do that. But this fund is open. It's going to remain open. The difference is, because of the nature of it being open forever, you have to be an investor in the fund at the time we make a private investment in order to get an allocation of that private investment, because we have to side pocket them to be fair to everybody in the fund. So that's the only big difference. But otherwise, we're super excited. We are very confident in Bitcoin long term. We enjoy the volatility, and it doesn't help my sleep cycles, but
doesn't help the sleep cycles, doesn't necessarily help liquidity in the short term, as it's a sponge just taking liquidity out of the markets on a regular basis. But but there is some benefits. And what I love about your fund is there in the crypto space, we all talk about investing in tokens early. The challenge is all of the Bitcoin economy, all the opportunities to invest there, they're not happening early through token launches right now. They're all happening through traditional fundraising. So if you want access to all of the financial products that are happening and being built around the Bitcoin economy, and there's a lot, insurance products, meanwhile, recently just raised $40 million, and like the list goes on down and down the list. The only way to get access to those is through a fund, either to be a VC yourself or through a fund like yours. So we'll throw the link in the show notes. Everybody can definitely check that out. James, appreciate your time today. Thanks so much for joining us.
Thank you for having me, and I look forward to the next time.
For sure. Thanks for listening in, everybody. Have yourselves a wicked awesome day. We'll see you again tomorrow.